So this is learning objective 2, recognizing accounts receivable. Recognize equals to record on the company books. So recognize equals record. When do we put a receivable on the company books? Well, it's usually as a result of a sales transaction. We go accounts receivable. And it's often a result of either a sales or service revenue. I'll call it sales revenue. Okay, and so say we had 120, all right, pick a nice round number. So, you know, this would be, if we did a sale on the 1st of September, that would be our journal entry. We know from just going shopping and returning things ourselves that all sales don't last, and so sometimes things are returned. So we have to, rather than unrecognize the receivable, if we have a return, we're going to use a sales returns and allowance account. So sales returns and allowances, and then we would reduce the accounts receivable because that customer returned something to us, so they do not owe us that money anymore. Okay, so we'll call that 20. Okay, so those are your two basic items. You could say, why don't we just reverse this entry? As a manager or someone who's running a company, you're going to want to keep track of how much your sales returns are. If it runs at a certain percentage for a few years and then all of a sudden it skyrockets, maybe it goes from 5 to 40%, why are your customers all of a sudden returning so much stuff? Is it because the quality has declined? Is it, you know, market changes? It is a, you know, it provides you useful information as a manager to know what's going on. Also, as an external user of the financial statements, if you're looking at a company to see how they're doing, and they have a huge amount of sales returns and allowances, it might be a bit of a red flag. Okay, so those are your two basic transactions. Then the other thing that happens with, usually between wholesalers and retailers, is that often as a wholesaler will grant the retailer a discount if they pay within 10 days. Remember the 210 net 30 from chapter 5? Well, we're running into that again here. So say the terms of this sale were 210 net 30, and they paid on the 8th, they paid us on the 8th, we would receive cash, but we would not receive the full $100 that were owed. We would only receive 98. We would refer to this as a sales discount or a cash discount. And that would be the $2, and then the accounts receivable would be fully satisfied, but that's with the sales discount. Okay? And you started out with a receivable of 120. It went down to 100 because some of it was returned. 2% of 100 is the $2 discount, and the rest would be, we would receive in cash. Okay, so that's on this side of things. And if you go back, I know in chapter 5 I do a little thing where I kind of draw out the different relationships, and so you have maybe a wholesaler here, you might have the retailer here, and then you have the customer here, the happy customer, mostly happy, okay? And so here you've got accounts receivable, and you've got your sales revenue, and you've got the money flowing this way, and you've got the goods and services flowing that way. Between the wholesaler, where the retailer gets its stuff, you have got the goods and services flowing this way, and you've got the money flowing that way, okay? So the wholesaler would have accounts receivable and sales revenue for things that it sold the retailer. The retailer will have accounts receivable and sales revenue for what it sells to the customer. It's on this side, it's between wholesalers and retailers, that you get the terms like 210, net 30. In other words, if you pay within 10 days, you can take a 2% discount. Otherwise, you have to pay at the end of 30 days. On this side of the building, on the customer side, here, they don't usually give those discounts. I mean, they just don't usually do that. Instead, what happens, if the customer doesn't pay on time, they add interest on to that account receivable. So say this person didn't pay on time, then what would happen is on this side of the building, you would have a situation where you might have, say, an account receivable, okay, of a couple $100, and you would have the sales revenue. I'm going to just call that 100. That works better for me. And so then, if the person doesn't pay it at the within the month, you're going to be adding on interest. And to do that, the journal entry is simply we add on to that account, that person's account receivable, and we, as the retailer, recognize interest revenue. Okay, and just say it was $2. Okay. So now that account receivable is $102 for that person, and so when they send a check, that's what the amount that they're going to have to send. Okay, so I think that's about all for learning objective number 2.